We're going to look with some numbers then at these intragroup transactions, and you could be asked to deal with any element of getting rid or eliminating these intercompany balances. So if we have a look at the requirement first of all, we've got to explain the adjustment to account for the cash in transit at the year end, and then show just some extracts from the consolidated statement of financial position. So we're just going to show inventories, receivables, cash, and the payables balance. If we have a look into the body of the question then to see what's happening, so we've got Pi acquiring 70% of the share capital of Soup. So we've got, if we sketch out a brief group structure, 70%, they've done that on the 1st of January X8, and that means there would be a 30% non-controlling interest. The year end that we're interested in is 31st of December X9, so they've owned their interest in Soup then for 2 full years. As at the end of the year, we can see fairly clearly on the face of the statement of financial position then that we've got an intergroup balance. So there's a receivable from Pi sat in Soup's financial statements of 52, and then there's a trade payable to Soup sat in Pi's financial statements of 41, and at the moment then these balances are not equal, they don't agree, so we can't just eliminate them as they stand from the group accounts, and that means then there must be some in transit items at the year end, and if we have a look at the additional information we're told about that here. So at the 31st December X9 there was some cash in transit, 11,000 going from Pi to Soup. With the cash in transit then, so it's 11,000 and it's going out of Pi and into Soup. So in transit over the end of the year, and if we just explain the accounting adjustment we would need to put through. So currently, as we've just seen on the face of the soft P, the intercompany receivable and payable do not agree. And as it stands at the moment then, we've got a payable within the group accounts of 41 and a receivable within the group accounts of 52. And the reason that these accounts don't agree is due to cash in transit at the year end. We need to eliminate, so we must eliminate the intercompany transaction and balance. And therefore we need to post the cash in transit to agree those accounts first. And we would post that cash in transit, and you need to learn the journal entries by pushing it into the receiving company. So the receiving company would debit cash and reduce down their receivables. They've now received the cash in payment. So debit cash and credit receivables, 11,000, 11,000. And when that was posted through in this case then, we would have 11,000 coming off the intercompany receivable, leaving with us with a balance of 41. Once that cash in transit has been posted through then, that means we could then contra out the accounts. So the purpose and the explanation of the cash in transit adjustment is to make sure that we're agreeing the accounts first and then we can contra them through. So once we've got the 41 as a payable and the 41 as a receivable, we would then remove them from the account. So we're going to reduce our payables, so debit payables by 41 to remove it, and reduce the receivables, so credit receivables by 41, again to remove it. And we'll show that with our second step. The balances per the statement of financial position then, we're just showing some extracts here. So A, they wanted us to look at inventories. So inventories will just have aggregated the balances and we haven't made any adjustments. So inventories 30 plus 17, and the balance in our inventories in the group accounts would be 47. For receivables, so for part B, we would start off with what we've got on the face of the group accounts. So we would have had receivables of 65 and 89, and then this internal receivable, so the intercompany receivable of 52, which we know we need to eliminate. So our receivables would be 65 plus 89, those are all external, and then if we look at what's happened to that 52, that would have been in there originally, so 52, but we've then posted a credit to receivables to do with the cash in transit, so we would have taken 11 off, and then posted a second credit to receivables to get rid of the intergroup element, so then taken off 41, and leaving that effectively cancelled out of the group accounts. So that would then turn to 0, and we would be left with the external balances only. So the receivables will be 154. Cash and cash equivalents, what we had on the face of the separate financial statements originally, so 7 plus 15 per the soft P for the parent and the subsidiary, but then we've posted through some extra cash to do with that cash in transit, so there would have been 11 added into that for the in transit items at the year end. So the cash balance will have gone up to 33, and our final balance payables again should be external payables only. So we would have 23 external, 21 external, which should be left within the group accounts, and then this 41 would be contraed out as part of that elimination of the intercompany balances. Payables then, 23 plus 21, so gives us 44, and we would originally have had that 41 in there to do with the intercompany, but then contraed it out by way of that adjustment, so the debit to payables to remove it from the group accounts, so that would have come out as that adjustment and left us with a balance of 0, therefore just the external balances only then of 44. So that lecture example, the key thing to learn from there is how to record the cash in transit, so make sure you can do that journal, and remember that we want to eliminate any intercompany payables and receivables. So step 1, force your accounts to agree, so deal with these in transit items, and then step 2, contra the intercompany balances out of the group accounts.